Thanks for coming. I just had a quick question on, so like in recent years, the number of hedge funds, private equity firms has gone up. And I wasn't sure how that's changed the efficiencies of the alternative asset allocation markets. And if it's changed the efficiencies, how have you changed your investment philosophy? And even if, and I was wondering also, what are the structural sort of patterns of these markets that would prevent the market from becoming very efficient, even if there are a lot of hedge funds and a lot of them.
So that's a really good question. I think the most fundamental issue with the explosion of hedge funds and the explosion of private equity funds has to do with this negative sum game that we were talking about. If you go back to the 1950s, the most common way that institutional assets were managed would be for an institution like Yale to go to a bank like Chemical Bank or JP Morgan, and they would pay a small fraction of 1% for a reasonably diversified portfolio of stocks, bonds, and it'd probably be some foreign stocks and some domestic stocks, but the leakage from the system was very small. And you look at hedge funds and private equity funds, they're essentially dealing with the same set of securities that an institution used to pay 0.2% a year or 0.3% a year for admittedly sleepy bank management, but it's the same set of securities. Now those securities are traded in a hedge fund format or taken private in a private equity fund format, and the fees that you're paying are a point and a half, 2 points, right? The typical 2 and 20, and you're paying a significant percentage of the profits, the 20 and the 2 and 20. Think about that. The leakage from the system that goes to Wall Street is enormous compared to what it was 10 years ago or 20 years ago or 30 years ago. So there's that much less left for us as investors. And I think that has huge consequences for endowments, foundations, pension plans, institutions of all stripes, and to the extent that individuals get exposure to these types of assets, and they're largely wealthy individuals that end up getting the exposure, they're going to suffer the same consequences of this huge leakage of higher fees and the profits interest to Wall Street. The question as to whether or not the money flowing to hedge funds is going to make markets more efficient and take away opportunities, I don't worry too much about that. I mean, I think that the best talent is going to hedge funds because if they're in a long-only domestic equity environment, maybe they can charge 0.75% or 1%, or if they're in the mutual fund world, maybe they charge 1.5% or something like that. Well, you'd rather have 2 and 20 than 0.75, right? That's easy. So there's a huge migration of talent to the hedge fund world. But what I care about when I look at the degree of investment opportunity is this dispersion that we talked about. And I haven't seen the dispersion of results, top quartile to bottom quartile, compress at all. So I don't think that we're increasing the efficiency of the pricing of assets. I still need to go out there and be able to identify people in the top quartile or top decile so that we can win relative to the markets after adjustment for the risks that we take. So as long as we have plenty of dispersion in the results, it's still an interesting activity for us to pursue.